Look at this chart for silver. It's not just moving up, it's moving like it just found its ex's password and is looking for a fight. On January 22nd, 2026, silver did something it hasn't done in human history. It touched $120 an ounce. But while everyone was celebrating the silver squeeze, the floor was being quietly ripped out from under us. In less than 3 weeks, silver didn't just pull back, it crashed 21%. I mean, it wiped out billions in paper wealth while most of us were still finishing our morning coffee, leaving a generation of regular guys holding a very expensive bag. You're probably wondering, was the moon shot a fluke? Or are we just witnessing the most violent buy the dip opportunity of our lifetime? Today, we're looking at why the world is literally running out of silver, why the big banks are terrified, and the one chart from China that proves, beyond a shadow of a doubt, that this story is far from over. To understand the crash, we have to look at the madness of January. For decades, silver was the boring metal.
Boring.
It was the poor man's gold. If gold was a tuxedo, silver was a pair of business casual khakis you bought on clearance. But then 2025 happened. Inflation didn't just stay high, it became part of the furniture. The Fed started cutting rates, the dollar wobbled, and suddenly, everyone remembered that you can't exactly print silver in a basement. By the time we hit New Year's, the silver squeeze wasn't just a Reddit meme anymore, it was a global panic. We saw industrial giants, Tesla, Samsung, the big solar firms, realizing they were fighting over a shrinking pile of metal. When the price broke $50, the momentum took over. When it broke $80, the FOMO kicked in. By the time it hit 120, your Uber driver was telling you to buy silver ETFs. And that, my friends, is usually the first sign that someone is about to get punched in the face. So, why did it break? Why did we go from 120 to 85 in the blink of an eye? It wasn't because we suddenly found a secret mountain of silver. It was the gravity of the greenback. In early February, the Federal Reserve dropped a bombshell. They signaled that the rate cuts everyone was betting on might be paused because recent jobs data came in stronger than expected. Suddenly, the US dollar surged, and commodities, which are priced in dollars, did the only thing they could do. They choked. But there's a darker reason for the crash that the mainstream news won't tell you. It's called margin calls. Think of it like a bouncer at a club suddenly deciding the cover charge just tripled while you're already at the bar. When the price of silver moved 47% in a month, the big exchanges got nervous. They told traders, if you want to bet on silver, you need to put up twice as much cash right now. This forced thousands of people to sell their positions all at once. It wasn't a natural sell-off, it was almost a forced liquidation, a stampede for the exit. And combined with the supply and demand dynamics, it was a disaster. Now here is where it gets interesting and why you shouldn't just look at the price on your phone. While the West was selling paper contracts, the East was buying the physical metal like it was the last bottle of water in a desert. Look at this. On February 9th, silver inventories on the Shanghai Futures Exchange hit a 10-year low. They are literally draining the vaults. To put that in perspective, China's silver stockpiles are now almost 80% lower than they were in 2021. This is the great disconnect. On one side, you have paper traders in New York selling imaginary silver because they're scared of the Fed. On the other side, you have the world's biggest manufacturers in China buying every physical ounce they can find because they need it for solar panels, 5G towers, and EV batteries. They know something the regular guy doesn't. You can't build a green revolution with paper contracts. You need the atoms. This brings us to the actual mechanics of the situation. We're currently entering our 6th consecutive year of a silver supply deficit. The world is expected to be short about 67 million ounces this year alone. Regular people often think that if the price goes up, miners will just dig more. But silver isn't like corn. You can't just plant more in the spring. 70% of silver is a byproduct. It's the extra stuff you find when you're actually looking for copper or zinc.
Oh my God! Wow!
If you want more silver, you have to build a multi-billion-dollar copper mine, which takes 10 years to permit. You have a better chance of getting a straight answer from a politician than you do of seeing a new silver mine open this year. We are eating into the above-ground stocks, the stuff in vaults and old silverware, but those stocks are finite.
Hell no, man.
We've already burned through over 800 million ounces of deficit in the last 5 years. That's a whole year of global mining output just gone. So what's the takeaway for a regular guy? 2026 is going to be a year of violent volatility. The big banks and the hedge funds are going to use these 20% crashes to shake you out of your position. They want you to think the bubble popped so they can buy your silver for $80 and sell it back to industrial giants for $150 later this year.
This is business.
This is my sweat.
I know, but I did business.
Shut up! Shut up!
The fundamental story hasn't changed. The warehouses are still empty. The demand for AI data centers and solar power is still skyrocketing, and the Fed can't print physical metal. The crash in February wasn't the end of the story, it was just the market taking a breath before the next leg up. But hey, I'm just a regular guy with a pen. Don't take financial advice from a drawing. Do your own research. Watch the inventories in Shanghai, and remember, in a world of unlimited paper, the only thing that matters is what's real. If you want to see me dig into what's happening with copper next, which is its own kind of madness, drop a comment below and hit subscribe. I'll see you in the next one.